What if I told you that some of the richest people on Earth worth trillions of dollars combined might not actually be backed by anything real? No vaults of gold? No warehouses of tangible value? No physical anchor tying that wealth to the real economy you live in every day? Just numbers, promises, and belief. Today we're going to explore a paradox that sits at the heart of modern capitalism. How unimaginable wealth can exist alongside growing instability, debt, and inequality, and why the system that created billionaires may also be quietly hollowing itself out. This isn't a story about evil villains twirling mustaches. It's a story about systems, incentives, and feedback loops that grew faster than our ability to control them. And by the end of this video, one uncomfortable question will remain: if billionaire wealth isn't grounded in something real, what happens when people stop believing in it? Setting the stage, how we defined real wealth. To understand the paradox, we have to rewind. For most of human history, wealth was simple. You could touch it. Land, crops, livestock, gold, and silver. If a king claimed power, it was because he controlled territory and resources. If a merchant was rich, it was because ships arrived loaded with spices, silk, or metal. Even early banks dealt with physical reality. Deposits represented actual gold stored somewhere. Paper money was just a receipt. But in the 20th century, something changed. After World War II, global economies exploded in complexity. Trade went international. Corporations grew massive. Finance became abstract. And in 1971, the final tether snapped. The United States abandoned the gold standard. From that moment on, money was no longer backed by a physical asset. It was backed by confidence. And confidence, it turns out, is infinitely expandable. Origins. The seeds of the paradox, the modern billionaire, didn't emerge from factories or farms alone. They emerged from financial engineering. Stocks no longer represented shared ownership in productive enterprises. They became speculative instruments. Derivatives allowed traders to bet on bets. Leverage made it possible to control billions with millions. This is where the paradox begins. A billionaire's net worth is not cash in a bank account. It's mostly paper value, shares priced at what someone might pay, assets valued by future expectations, wealth dependent on continuous growth. If the stock price falls, the wealth evaporates. But during long periods of expansion, especially when interest rates are low, those valuations can soar far beyond what the underlying businesses actually produce. And the higher they go, the harder it becomes to ask the uncomfortable question: what is this really worth? The rise. How trillions were created from belief. From the 1980s onward, everything accelerated. Governments deregulated finance. Central banks intervened to stabilize markets. Cheap credit flooded the system. Each crisis was met with the same solution: lower interest rates, more liquidity, bigger bailouts. This had an unintended side effect. Asset prices rose faster than wages. Stocks rose faster than productivity. Wealth concentrated at the top. Billionaires didn't need to sell anything real. They just needed prices to keep rising. A tech company could lose money for years, yet gain billions in valuation because of future potential. A hedge fund could generate returns not by building, but by arbitraging tiny price differences at massive scale. The economy increasingly rewarded ownership of assets, not creation of value. And as long as markets believed in the story, the numbers kept growing. The breaking point when reality pushes back, but belief systems have limits. Eventually, reality intrudes. When inflation rises, central banks can't print endlessly. When interest rates climb, leverage systems strain. When growth slows, valuations face gravity. This is the breaking point of the billionaire paradox, because billionaire wealth is fragile in a way traditional wealth was not. A factory still exists after a downturn. Land still produces crops, but inflated asset values can disappear overnight. We saw glimpses of this in the dot-com crash, the 2008 financial crisis. The sudden collapses of too big to fail firms each time. Trillions vanished in paper. And yet the system survived. Not because it was fixed, but because it was patched. Fallout: who pays when the numbers fail? Here's the crucial cause and effect chain. When asset bubbles burst, the wealthy lose paper value. But when systems collapse, everyone else pays. Jobs disappear, savings shrink. Public debt explodes. Governments step in to stabilize markets, not households. Why? Because modern economies are so intertwined with financial markets that allowing them to fail risks total collapse. So losses are socialized. Gains remain private. This reinforces the paradox. Billionaires become richer during booms, while society absorbs the cost of busts. And over time, trust erodes. Failed fixes, why nothing seems to change after every crisis. Reforms are promised. New regulations, stress tests, transparency rules. But the incentives remain. Markets reward short-term growth. Politicians fear market crashes. Central banks prioritize stability over restructuring, so the system doubles down. More debt, more leverage, more reliance on confidence, and fewer connections to physical reality. Modern parallels the pattern repeats today. The paradox is more extreme than ever. A handful of individuals hold wealth comparable to entire nations. Stock markets hit record highs while real wages stagnate. Entire sectors are valued on narratives rather than profits. We see the same pattern repeating. Rapid expansion, speculative excess, moral hazard intervention reset. The names change. The technologies change. The logic doesn't, and each cycle grows larger, riskier, and harder to control. The takeaways: 3 hard truths. First, billionaire wealth is not the same as money. It's a snapshot of belief, frozen in time. Second, systems built on confidence require constant reinforcement. When belief fades, numbers collapse faster than they rise. Third, when wealth detaches from real value, instability becomes inevitable. You can't infinitely abstract reality without consequences. The warning and the open question, the billionaire paradox, isn't about jealousy or blame. It's about sustainability. How long can an economy function when its greatest rewards are disconnected from everyday life? How many crises can be patched before belief finally breaks? Most importantly, what happens when people realize the system needs their trust more than they need the system? If this video made you question what wealth really means, share it with someone who still thinks the numbers tell the whole story. Subscribe for deeper breakdowns of power, money, and systems we're told not to question. And leave a comment with your thoughts. Is billionaire wealth a sign of success or a warning signal we're ignoring? Because the answers to those questions will shape what comes next.